Good afternoon to the MIM members and friends from the industry. Thank you for joining us today for this important and relevant webinar on German businesses in India, key avenues of financing and associated legal and regulatory watch-out areas being organized under the Make in India Mittelstand program in association with our eminent partners, Deutsche Bank and Khaitan and Company. I'm Jamli John. I'm responsible for the business development and PR for Roland Partner Office in India, and I'd like to take you through the session today. We will surely have our chief guest joining us, Mr. Srikumar Vitil, the marketing officer from the Embassy of India, Berlin. He has requested for an apology because he's slightly delayed because of a meeting and will join us later during the session. We are pleased to welcome our speakers for today, Mr. Manish Singh, Assistant Vice President, Corporate and Investment Banking, Global Subsidiaries Coverage, Deutsche Bank AG, Filiale Pune, and Ms. Bhargavi Patel, Vice President, Corporate and Investment Banking, Global Subsidiaries Coverage, Deutsche Bank AG, Filiale Mumbai. We also have with us Ms. Manisha Shroff, Partner, DCM and Banking and Finance Practice Group from Khaitan and Company. We'll request all the attendees to kindly post their questions in the Q&A section, and this will be taken up during the last leg of the webinar during the Q&A. Please note that you will be in muted mode, and we'll request you to kindly not unmute yourself. In case if there's any questions, you can raise your hand or put it in the question answer box to us. We'd like to welcome our first speaker for today from Deutsche Bank, Manish Singh and Ms. Bhargavi, who will give us an overview of the financial solutions for the corporates. Give me a moment till I open the slides, please. Maybe you can already introduce yourself, Manish and Bhargavi.
Thanks, Jamli. Thank you for the introduction. Good afternoon, everyone. I am Bhargavi. I've been with Deutsche Bank in India for the past 11 years, and I'm part of the corporate coverage team. Manish, maybe a short introduction.
So, hi, I'm part of the global subsidiary coverage team of Deutsche Bank in the corporate banking division. I've recently joined Deutsche Bank, but I have an extensive experience of 8 years with banking and corporate banking.
Thanks, Manish. So I'll directly jump on to the presentation. What we will cover today is the various financing solutions for corporates in India, with a focus primarily on what MNCs typically look for in terms of how to fund their subsidiaries in India for all purposes. It can be short term, it can be long term financing, etc. Right? Generally, we can move on to the next slide.
Manish, I have given you control. Just if you could check. Yes, please. Thank you.
So quickly, in terms of agenda, I will quickly cover what we do in India, give a summary of the different financing options, then focus on 3 areas or 3 solutions which we see are key for corporates in India. And then 2 themes or 2, one is a government incentive and one is basically sustainability financing. 2 things which are extremely well talked about and extremely relevant for corporates in India at the moment. Coming on to Deutsche Bank in India, Manish, next slide. We've been in India for the past 40 years, very well capitalized, covering a host of solutions across cash management, trade finance, foreign exchange, hedging solutions, various structured solutions. Our specialty is probably to understand what corporates exactly require, where are their pain points, and try and address that. Even with respect to financing solutions, while of course there are a lot of plain vanilla solutions, we try and structure what a client really requires to give them the best, most efficient form of financing. It can be in the form of say less of documentation or a better interest rate, etc. So we guide the clients with respect to regulatory advisory on the transactions, what is possible, what is not possible, etc. I'll not spend more time on the slide. I'll directly jump on to the financing solutions which are available. So coming to this slide basically captures all the various kinds of financing that corporates avail. So if you see column A is group financing, which has primarily equity funding, which a corporate can do into the country, and an external commercial borrowing or a corporate loan from a parent or a group company into the Indian subsidiary. We'll cover more of that in the latter slides. Both these can be used for long term as well as short term and with various end uses. Coming to bank financing, of course, long tenor primarily is used for capex financing. Then there is another solution called reciprocal financing, which is basically an INR loan given in India, backed by a deposit or a surplus placed with Deutsche Bank branch in another country. So this typically is a financing wherein the corporate does not need to infuse equity into the country or give an inter-corporate loan into the country, thus saving on the FX risk which could occur with respect to a loan. With respect to short-term financing or working capital requirements, there are plain vanilla solutions like overdraft or a short-term loan, which can be used through the length and breadth of the entire spectrum of purchasing raw material up to getting the payment for the end use of end product which is sold. Then there are financing which are specific to specific parts in the procurement and the entire life cycle of a good. So there is buyer's credit or foreign currency import financing, which is towards raw material or a capex purchase of goods. Then there is export financing for financing all your exports. Then these two would be spoken about more in detail by my colleague Manish. Then on the receivables side too, we've seen a lot of interest coming from various corporates with respect to receivables purchase or factoring. This helps to reduce the outstanding days sales for a company. Another area of maybe financing or another area which corporates generally are focusing now on is also supplier financing. Especially with the disruptions which are happening in the market right now. So everything with respect to logistics has been disrupted, and suppliers of bigger corporates find it very difficult to avail financing at a slightly lesser rates. As such, this is a key financing area wherein the suppliers, backed by a strong corporate rating of the anchor, is able to avail financing at a cheaper rate. This helps to reduce the DPOs for the anchor clients. LC bill discounting is another common source for usance LCs in case LC is used as an instrument during the sale of goods. Moving on to the next slide. Some of the key parameters that companies use while evaluating financing alternatives. One is, of course, who all are the eligible lenders? Can it be a group company, or can it be only a bank in India, or can it be an offshore branch of or a foreign branch outside India? So these are covered across the key financing solutions which I've mentioned. Another is restriction on sizes. So if it is a bank financing, then of course the risk comes into picture. Depending on the risk appetite of a bank on a corporate, they would lend up to a specific amount. With respect to buyer's credit or foreign currency financing or INR financing for your imports, there is a regulatory restriction in terms of the amount that can be borrowed in a certain year. With respect to end use too, it varies across, and I've already covered that in the previous slide. Interest rates too depend on the bank who is lending to the corporate, and varies primarily on the risk appetite for the bank that the bank has. With respect to the benchmarks which are variously used in the financing, so it can be a bank benchmark, which is MCLR. This is typically published on all banks' websites, or it can be a T-bill or a commonly used benchmark like a T-bill or a MIBOR linked benchmark, which is used. Again, in terms of capex loans or medium-term loans or ECBs, these can be used primarily only for capex purposes, and typically long tenor loans are used from the purpose of lending to corporates. With this, I will move on to the next slide and hand it over to my colleague Manish. No, that's not good.
Hello. Yeah, thank you, Bhargavi. And I will now talk of some focus areas that we have identified, which are very prevalent in terms of global subsidiaries in India. This is completely out of our experience that we have seen a lot of global subsidiaries using these products more often than the others. It's not going to the next slide, Jamli.
Okay.
Yeah. So the first product that we will talk of when we talk a deep dive into a few products is external commercial borrowing. It is one of the most widely exercised financing option for financing the Indian subsidiaries of global corporates. I think it's now going to some. Sorry.
Are you able to handle it? Yeah.
I think it's there's a lag. So the first product that we're talking about is external commercial borrowing. This is most widely used, say, product when it comes to funding the domestic subsidiary for a global client or a global company. This is regulated by the regulator RBI in India, and over time, gradually RBI has come up with a lot of flexibility in terms of end use of funds. And with time, we have seen that most of the end users have been allowed by RBI, like general corporate purposes, working capital, capex, even to repay, say, INR borrowings that a subsidiary would have in India. ECBs can be used for repayment of that as well. There is a restriction in terms of maximum all-in cost for the borrowing in terms of ECB. For any borrowing in foreign currency denominated borrowing, it is benchmark plus 500 bips for any fresh loans, and for INR backed ECBs, it is benchmark plus 450 bips. So eligible borrowers in this case would be all sectors which are eligible for bringing in FDI into India, and as well as port trust and other entities are also eligible borrowers. Lenders can be residents of any FATF compliant country. So as we have audience from Germany, Germany is a FATF compliant country. So any sub group which is based out of Germany are eligible lenders in this case of ECB. Say in case of that, if there is a subsidiary and it should have at least 25% direct holding or 51% indirect holding to be a recognized lender. Similarly, foreign branches of Indian sub banks and as well as MNC banks can be, say, eligible lenders for an ECB. Another addition to this list is GIFT City branches of banks. We will talk about GIFT City in the coming slides. As I told you, there are a lot of permissible end uses that the RBI has allowed now. And that's the reason this product has become very widely accepted across the subsidiaries in India. So the other product that we wanted to speak more about was related to import financing. As we are aware that local subsidiaries of any global company is mostly dependent on imports as the raw material, imported raw material for their operations in India, and gradually they localize the raw material sourcing. So buyer's credit is one product that is very widely used for financing the imports for any company. And buyer's credit can be used either for working capital as well as for capex. For working capital, the tenors are up to 1 year. Allowed tenors as per RBI are 1 year, and for capex it is up to 3 years. And generally, if you see, there is also a capping in terms of the all-in cost here, which is benchmark plus 300 bips. Similarly, as we spoke about GIFT City is an international financial service center that is being promoted by Government of India big time, and a lot of Indian and as well as global banks are setting up their branches in GIFT City. So any GIFT City branch in uh, any branch of a bank in GIFT City is treated as an offshore branch, and they can do a lot of financing as well as take liabilities in the GIFT City branch. So, and there are some innate benefits of funding through GIFT City. First one being that as the Government of India is promoting it, there are some cost benefit in terms of withholding tax not being applicable. A lot of local liquidity statutory cost also goes down. There is a time zone benefit wherein in case Indian importer has to avail of this buyer's credit from a foreign bank which is based outside India, then they have to match up to the time zones. But definitely when the branches are in India, they have this advantage of time zone as well. DB has a distinctive advantage in terms of operating out of GIFT City, is that we leverage upon the KYC that we have for the corporates in India and across globes, and the onboarding process for a corporate in GIFT City branch becomes very fast. The next topic is regarding export financing. Export financing can either be pre-shipment credit or post-shipment financing. Pre-shipment credit can be taken either in foreign currency or Indian INR, and this has to be from an onshore branch in India, and it can be linked to any benchmark depending on the currency. And generally, in our experience, we have seen that the packing credits are up to 6 months, but the regulations allow it to be up to 360 days. Similarly, post-shipment financing can either be in a INR or FCY, and similar, say, terms in terms of the period and the rates. There is another, so Government of India, just to boost the exports from the country, has come up with an export subvention scheme, which wherein a 3% subvention is given to MSME manufacturers who are exporters for all HS lines, and there are some 410 HS lines for which all exporters get a subvention of 2%. So this results in overall borrowing cost reduction for the corporate, all the exporters. So now we will talk of some thematics which are very recent and are much talked of in the industry. The first one is sustainability and financing. So as today we know that there is a lot of thrust on sustainability, and finance as a field is no exception to it. We have seen that a lot of finance companies are taking long strides towards sustainable financing. DB is also committed towards the sustainability initiative, and we are the front runners in terms of our overall commitment to ESG, as we are targeting 200 billion ESG financing plus portfolio by 2025. So when we talk of ESG financing or sustainable financing, we are currently working on 3 themes. One is the use of proceeds, second is company profile, and third is sustainability linked financing. So when we talk of use of proceeds, it is in terms of funding projects which actually help in sustainability improvement and protection of the environment. This could be in terms of also helping the marginalized sections and target groups. Second is in terms of the company profiles. Companies who say earn more than 90% of their revenues from ESG activities. ESG activities could include microfinance, renewables, and MSME infrastructures, and we try to fund these company profiles. Third one is sustainability linked financing, wherein we try to pre-agree on some sustainability targets with the borrower, and if the borrower is able to comply with the sustainability targets, it finally results into, say, reduction in margin in terms of the overall cost for the borrower. We also have had some very recent use cases in terms of the sustainable financing. The first one being, say, we have tried to fund a lot of renewable energy related projects like solar, wind setups. We have also successfully issued green bonds recently. There are long-term AR purchase solutions towards capex, for example, say building of a hospital. And then there is ESG related supplier financing products that we also offer to our clients. The last thematic that we wanted to discuss about is related to the PLI scheme. The government of India in the year 2020 came up with a production linked incentive scheme, which to our mind is a big success in terms of a lot of investment coming into India. The proposed incentive by the government of India is almost 30 billion euros and it is expected to bring in investments of around 500 billion, so generating revenues of around 500 billion by 2027. It is a turnover linked incentive scheme, and the government of India has identified some 14 sectors that they want to promote. This is majorly to take care of three things. One is to promote India as a manufacturing destination when the entire world is talking of, say, China plus one strategy in their global supply chain. This program actually came in at the right time, and India could be one of the beneficiaries of the strategy wherein all the global corporates are trying to deleverage or maybe de-risk their supply chain by adding another, say, base for their manufacturing. Other one is to bring down our import bills, as we are net importers, and the government wants to, say, boost the production in India to maybe lower the import bills. And the third is for generation of employment for a huge pool of, say, talent that we have and technical staff we have in India. So when we talk of this scheme, the largest, say, beneficial sectors for the PLI scheme are semiconductors and display, because we import a lot of electronics, large scale electronic manufacturing, autos and drones. So some of them are also future ready products like fuel cells, investment into advanced cells and batteries. So all these sectors are being promoted by the government of India. We will also share some details and some links wherein you can read into more details about these schemes. Thank you. And these are our contacts. We will also share this presentation after the session, and you can reach us on the contact details that are mentioned there.
Thank you so much, Bhargavi and Manish. I'd now like to invite our next speaker for today, Ms. Manisha Shroff, who will give us the overview on the financing avenues for German businesses in India, the legal and the regulatory watch-out areas. Manisha, I'll give the control over to you. We're able to see the screen, Manisha. Please go ahead. Thank you.
All right.
Yeah, you're audible now.
Yeah, thank you so much. Hi, everybody. This is Manisha Shroff. I'm a partner at Khaitan and Company. I practice banking and finance. As the theme for today is financing avenues for German businesses in India, we have kept it quite focused to these areas. Without much ado, I'll just jump into the main presentation. So on your screen, you can see that there are basically 5 main routes for investing debt into India. Manish touched upon, Deutsche Bank touched upon the first 3 columns which are shown on the screen, which is external commercial borrowings, export financing, and the third one is FPI NCDs, which is another route which is used. And the other two routes which you see is more for a strategic and long-term view into India, where you basically establish a fund vehicle through a FVCI, foreign venture capital investment vehicle, or an AIF vehicle. So this is the AIF vehicle, you have to have a presence in India. So that is the only route where you have to have a offshore feeder fund, which basically feeds in money into India. So going to the first column, the ECB master directions, there are basically ECBs available without any regulatory approvals. There is also a regulatory approval route in case you do not fall within the four corners of the automatic route. You can raise both foreign currency denominated borrowings from German entities, as well as, you know, if it's a offshore parent wanting to fund its subsidiary in India, this route can be used. Similarly, for the third column, which you can see, which is the FPI NCD route, which can also be used by a German parent entity to invest into India. Under the ECB regime, there is an all-in cost ceiling. You cannot exceed this ceiling for a particular ECB, which is 450 basis points. It has been increased for a temporary period till December 31st, 2022 by 100 basis points. The amount which you can raise is $750 million in a financial year. And for, again, till December 22, there is a dispensation and you can raise double of that, which is $1.5 billion in this particular year. The ECB has to have a minimum maturity of 3 years. It can also have a higher maturity. And if you're a foreign equity holder or like a parent funding a subsidiary in India, there are various, you know, dispensations available. For example, you can do a 5-year ECB for general corporate purpose, etc., which would otherwise, in a normal situation, if you're not a foreign equity holder, would be a higher limit of 10 years. Now, going on to the second column, which is export financing. Of course, this would be a German factor with doing an export financing with an Indian supplier. Here, the main highlights of this route are that the shipment must be made within 1 year from the date of receipt of advance payment. And secondly, there is a cost cap. If the export, if it is for less than 1 year, then the rate is cannot exceed LIBOR plus 100 basis. If it is more than 1 year, it is LIBOR plus 200 basis. There are no restrictions on returns except that the all-in cost ceiling is capped. Going on to the next one, which is the FPI NCD route. This requires that you take a SEBI license. SEBI is our securities regulator. You need to take a license in order to basically invest into India, into NCDs as well as equity. You can do both debt and equity through the FPI route. Concentrating on debt, you can do unlisted as well as listed debt, GSECs as well as T-bills. There are no pricing caps under this route. That's why it's a preferred route by many, because there is no all-in cost ceiling. And the debt instrument, if you are coming through the VRR route, there is no minimum maturity restriction also. We will talk more about it when we come to the main slide. FVCI route is only for 10 specific sectors, so sometimes doesn't fit all. So I'm not going to concentrate too much on that. We have talked about it in the slide. The AIF route is only if you have a long-term view in India, and it's basically you want to establish an Indian presence with an investment manager in India managing the vehicle. So moving on to the next slide. This is the slide which we touched upon in the various routes. So the FPI route, the mode of borrowing is in INR. This is basically the German company will lend into India in INR. They will have to get a SEBI license. As I said, the license doesn't take long. It can be obtained within a period of 4 to 6 weeks. You can fund there are very limited end-use restrictions. Only if you are doing real estate business, capital market transaction, or purchase of land. But again, there is a special route called VRR route. If you come in through that route, there are no end-use restrictions. And but the other way is that you need to keep the money in India for 3 years if you come under the VRR route. For security, security is permitted. You can take charge over Indian assets You can take guarantees from Indian companies. So this that is why you can see why this route is preferred by many. The VRR limits are a monetary threshold which is notified by our money regulator RBI. Currently, a lot of limit is available. 67,000 crore INR is available for the VRR route, and a much higher limit is available for the non-VRR. For the VRR route, as I said, there is no minimum tenor, there is no minimum maturity, etc. But the only thing is that you have to keep that portfolio committed in India and for 3 years. You can move around the investments into various companies. If you have a couple of portfolio companies or different companies in India, you can take it out from one company and put it into another. If you come through the non-VRR route, you cannot have just one investor. The second thing is that you'll have to have a minimum of 2 investors. So that is to be kept in mind. That is why the VRR route is preferred if you have a parent subsidiary sort of a financing. Rating, etc., is not a compulsion. Rating is only necessary if you do a listed instrument. The FPI route also permits for unlisted. So there is a choice of that. Exit can be done. If you are through the VRR route, you can exit only after 3 years. If you wish to exit before that, you will need to take RBI approval. However, you can shift your limits to the general investment limit and not be in the VRR limit. Taxation is also subsidized if you invest in through the FPI route. It is only 5% plus surcharge and cess, which is around 5.26% it comes to, provided the coupon on the NCDs do not exceed 500 basis over the state bank prime lending rate. So essentially around 15%, if your interest is within the range of 14 to 15%, you can get the benefit of this 5% withholding tax cap. Consent analysis, of course, if you lend into Indian companies and there are other lenders sitting in the company, we need to do this analysis and get those consents. But these are more contractual in nature. It's not a regulatory consent. We have talked about the tenor transferability. You can transfer this freely to another FPI at any point of time. You can transfer to a domestic after 1 year. Investment restrictions, as I said, if you come through the non-VRR route, you have to have a minimum of 2 investors, but VRR, a single German company can invest into an Indian company without this requirement of having minimum 2 investors. Investment limits are available for both the routes. A much higher limit is available under the non-VRR route of 5,54,000 crores, and a smaller limit for VRR is available at 67,000 crores. So it's quite easily available on tap. Now, just a little bit about the FPI license, because you will have to get a license if you invest into the FPIs. This takes around 3 to 4 weeks. You have to give all your beneficial ownership documents as well as the source of fund documents which you will be using. There are 2 categories which are popular. Category 1 is the government and government-related investors, all your pension funds, etc. And second is the category 2, which is basically your corporate bodies, family offices, individuals, unregulated entities which cannot fit into category 1. Most FPIs fall under the category 2. The documents which are required are KYC, some account opening in India. You need to get a PAN registration with the Indian tax authorities, and an allotment of the CPS limit under the FPI VRR if you opt for the VRR. But VRR is not a compulsion, it's a choice. Now coming on to the second most popular debt route, which is the external commercial borrowing route. The investment in the FPI route is mainly through a bonds or NCD, which is an instrument-based lending. However, ECB route, you can do either bonds or loans. There is flexibility there. In fact, the sustainability-linked loans which are being done are mainly through the ECB route amongst the ones which have been already lent into India. The mode of borrowing, a German lender, Germany is a FATF compliant jurisdiction, so it is permitted to lend into India. There is no other special eligible lender approval which is required. Under automatic route, the German entity can come in and they can lend. There are certain end-use restrictions which are important to note for the ECB route. You cannot use it for real estate activities, capital markets, equity investments, working capital, except if you are a parent. to a subsidiary in India, general corporate purpose as well, the same thing, and repayment of rupee loans. As you can see, there are special benefits available for foreign equity holders. You can actually finance general corporate purpose, repayment of rupee debt, and working capital expenses. Security is permitted. You have to take NOC from the authorized dealer bank in India, which is really not a regulatory approval as such. AD banks, basically, what you just need to show them is the documentation in relation to the security being coterminous, etc., with the loan, and you will get this NOC within 3 to 4 days. It doesn't take longer than that. The all-in cost we talked about, you cannot exceed cap which is specified in the regulations, 450 and 500 basis for INR versus foreign currency denominated ECB. We talked about the minimum maturity, etc., which basically, if you can see the table, it is essentially, if it's from a foreign equity holder, there is a dispensation. You can take it for a shorter period of 5 years. But if you take a working capital and general corporate purpose loan from any other entity which is not a foreign equity holder, it is about 10 years. And depending on the sector you operate in, there are some distinctions made in the ECB circular. Now moving on to some distinctions between the ECB and FPI route, because there is always a debate as to which is better. In terms of flexibility, hands down is the FPI route, which is more flexible because there is just very limited end users. If you can see, there is only, and that also the end users go away if you do a listed instrument or you come in through the VRR route. In terms of the investment limits, you are capped at a 750 million for a ECB per year. For this year, it's 1.5 billion, but otherwise 750 million. Whereas in FPI route, there is no limit till the limits are available from the government, which is very high right now, 67,000 crores. You can invest as much amount as you want. You have to buy limits every time you want to invest into India and keep that within for 3 years in India if you come through the VRR route. There is no such requirement for 3 years if you come in through the non-VRR route. Security under both the routes is permitted, so there is no problem. Even personal guarantees and corporate guarantees are permitted. The only difference in ECB route is you need to take a AD bank no objection certificate, which is not applicable in case of an FPI route. That's why it's got less paperwork and regulatory requirements than a FPI route versus an ECB route. Coupon is the biggest distinguishing factor. Coupon, there are no coupon limits, upper caps for FPIs. Of course, if you want to take the tax benefit, you have to keep it within the SBI prime lending rate plus 500 basis. But if you do not want to stick to a cap, checking the tax consequences, you can basically have a higher coupon as well. In ECB, there is constraint. You are capped at a certain all-in cost, which we talked about in the previous slide. Exit mechanism is much easier in the FPI route. All you can do is you can simply sell it to another FPI. You can even sell it to an Indian. And in case you want to go through the regulatory routes, those are also available if you want to shift your investments within different routes. Under the ECB route, you require a prior regulatory approval. If you want to, not keep or stick to the MAMP, the minimum maturity, average maturity period, you will have to take a prior RBI approval for exiting the investments. Else you'll have to wait till the 3 years or 5 years which you had specified at the time of taking the loan is up. Transfer of an ECB to third party, provided it qualifies as an eligible lender, you cannot transfer the ECB to a company which is residing in a non-FATF compliant jurisdiction. So that is a requirement at the time of transfer of ECBs which has to be met. Minimum maturity we talked about. For ECBs, there are different types of minimum average maturity which need to be met for different types and end users. Whereas under the VRR route, it's you have to keep the capital in India for 3 years, but you can shift it around, and there is no minimum maturity period or no minimum tenor, etc., which has to be there. For non-VRR route, you have to have a minimum maturity of 1 year. So I just pause there on those two routes. We now move on to export financing. I think Deutsche Bank talked about it in greater detail, so we will not delve too much into detail. Basically, the main regulations which govern this are the FEMA regulations, and the main regulator is the RBI and the DGFT, which basically regulate this. All contracts and invoices have to be denominated in freely convertible currency. Please note that Indian rupees is not a freely convertible currency. All export proceeds need to be realized in freely convertible currency. Specific exports and export proceeds may be realized in rupees, provided they come through an account called the Vostro account. The main regulation which governs this is the Master Circular on Exports of Goods and Services. It has very specific requirements. We discussed about it in the first slide. Essentially, there is a cost cap which is specified, which needs to be adhered to if it's for less than 1 year. And if it is more than 1 year, it's LIBOR plus or any other benchmark, since LIBOR is no more being used, SOFR, etc. is being used, that plus 200 basis if it is more than 1 year. The main, again, gatekeepers of this is the authorized dealer bank, similar to our ECB framework. The authorized dealers sort of keep it. In case of both conventional factoring and reverse factoring is permitted, so you can choose whichever one works for your particular transaction will work. In this diagram, the German entity will be the offshore factor, just to give you a bit of sense as to the diagram on the right. Just going into a little bit of specifics, there needs to be a tri-party agreement in relation to the export order. Without that, the regulations require that there should be this kind of contract. Third-party payments are also permitted, and there are no pricing caps in relation thereto, and they have to be routed through normal banking channels. Typical declaration forms, etc., are available. Rate of interest we already talked about. Authorization, as we said, that it has the gatekeepers are the 80 banks which have to support this. Settlement of export transactions can not having a direct exchange rate, etc., is also dealt with quite easily and very much in detail in the export regulation. So that's the overview of the three main routes. External commercial borrowings, there is no licensing requirements, so it's a very, very expedited timeline. If you decide today, you can complete the transaction within 3 to 4 weeks, even lesser in some cases. It's a much easier framework. The only downside is that there is an all-in cost. There is restrictions on the end users which you need to navigate. Having said that, it still continues to be a very popular route. All ESG and sustainable and green financing has come in through this route. The FPI NCD route, a license is required. However, it's much more flexible in terms of end use and pricing. And if you decide to list, then the disclosure norms, etc., start to apply. However, we have seen again these transactions, if there is no rating exercise involved, it can be completed again within 3 to 4 weeks. And if listing is involved, maybe another 2 weeks can be added just for the different processes associated with it. Export financing, quite easy and convenient through and permitted by the RBI. There is no RBI approval required, etc. And the all-in cost caps and the documentation is pretty precisely followed. However, it's a very easy and convenient route, as well as simple regulations around exist. So a little bit about us. We are in 7 cities in India. We are 1,000+ lawyers firm, the biggest law firm in India. And we are the exclusive partners for MIIM for the German channel. To basically cater to our German clients, we have a specific German desk dedicated to German clients, and we have advised already to all the companies which you can see on the slide, all the big groups which you can see, as well as banks. We advise end-to-end from the transaction, and we are full service. So whether it be corporate, litigation, banking, employment, restructuring, acquisition, tax, we have capabilities for all. This is our German desk partners, senior partner Rabindra, Naren, and the contact details for myself are given on the right as well. So thank you very much. I'll just pause there, and if there are any questions, we'll be happy to take them.
Thank you, Manisha, so much for the very detailed presentation. I'll request our speakers also from Deutsche Bank to put on their cameras, and we can take a few questions which I have now for the Q&A session. After the Q&A session, we will have the closure from the embassy side. I think a very interesting session that we had today. Some questions which have come in. I'll address it first to Deutsche Bank. First question is, for a capex funding, is there a regulation around debt versus equity component? And can a bank fund for a land purchase? Manisha or Bhargavi, whoever you feel would be deemed to answer it.
So as such, there is no restriction in terms of debt to equity in for a capex financing, but generally in Indian banks, a ballpark figure would be 25% equity and 75% debt. It can the equity part can go as low as 15% for financing. Generally, as Indian banks, we don't fund in India. Banks don't fund land acquisition during a capex. It has to be mandatorily through an equity or any other instrument in terms of borrowing through NBFCs and other non-banking financial institutions.
Okay.
So to add to what Manish said, Jamli, even if it's an intercompany loan or an external commercial borrowing from a corporate, the debt to equity component comes into picture if it is a direct shareholder who is lending to the Indian entity. The component is 7:1 debt equity ratio. That's important. And however, even in case of an intercompany loan, real estate or purchase of land is not a permitted end use. So real estate in general has to be from your own internal accruals or the earnings in India.
All right. Okay. I'll ask the next question to you, Manisha. So under the RBI master directions, can the period of realization of export proceeds be extended beyond the stipulated period of 9 months?
Yes, it can. Yes, it can be extended by another period of 6 months. There are certain conditions around it. Basically, that transaction itself shouldn't be under investigation, and there should be a reasonable rationale provided as to why the extension is being sought for. And with that, the AD Bank has the authority to extend it by another 6 months.
Okay. I'll also ask the next question to you. So, how are the limits under the FPI route acquired by an investor?
So it's an online process. You have to go to the Clearing Corporation of India website. So long as the limits notified by RBI are available, which right now it's 67,000 crore for VRR, and it's around 5,50,000 something crore for the non-VRR. You can go on the CCIL website online and purchase the limits easily on tap. So it's a very easy process, not at all difficult, and anybody investing can be easily guided through that.
It should be guided through. Okay. The next question for Deutsche Bank would be, what is the periodic regulatory compliances related to ECBs?
Manish, actually, I can take this. Oh,
yeah.
Go ahead. Okay, so basically, once an ECB is availed, every month the corporates in India have to file an ECB2 return, which gives an overview of the funds which have been drawn down in that month, or how the funds have been utilized, and whether the funds have been utilized towards the said end use. So when an ECB is drawn down, you have to specify the end use as to why you are bringing these funds into the country, or why do you need this loan. The ECB2 returns are primarily required to monitor this end use in terms of whether the drawdowns have been correctly done, whether the end uses have been correctly met or not, and these are supposed to be certified.
Okay. I'll post one more question to both of you. Is it possible to carve out global banking lines for the global bank and assign it to an Indian subsidiary?
So generally, yeah. So all the MNC banks which are present across the globe and also have presence in India, can take a call on the parent entity and can assign a limit to the parent entity, and then can say carve out limits for different geographies. At Deutsche Bank, we do it a lot because we are heavily present across the world. We are present in some 56 countries, and we do it for, say, subsidiaries of global companies in India. So that is possible.
It's possible. Okay. Manisha, over to you. How would enforcement of security work when security is created in favor of an Indian security trustee?
Yeah, so the Indian security trustee will enforce that security into India, and you will have to, it is permitted to take the money out of India, provided the route you have invested is a permitted route. So there is no hassle in taking out the money, so long as you follow that channel. And usually security is created in favor of an Indian security trustee for both the ECB and the SBI routes.
Okay. I'll take one more question for you. So, can ECB proceeds be utilized for general corporate purposes and working capital purposes? Is it possible?
It's actually under the negative list, both of these end uses. However, there are some dispensation given if for foreign equity holder, and if the tenor of the ECB is much higher. So for example, if you are not taking it from a foreign equity holder, the ECB will have to be of 10 years. If you take it from a foreign equity holder, for these two purposes, you can take it, and it will be for 5 years for a parent company, for example.
Parent company. Okay. I'll take the last question for today. That will be to Deutsche Bank. Are there any cap or any payment penalty for the ECB, just like max all-in cost?
So generally, for an ECB, the prepayment penalties, so after, say, achieving the minimum average maturity, if there is a prepayment, the maximum prepayment penalty cannot exceed 2% over and above the sub-benchmark cost, the cost that is agreed for the loan.
Loan.
So 2% is the cap, yeah.
2% is the capping. Okay. I think we have some more questions. Perhaps we can take it up later individually with both of the parties here. I'd like to really thank the Embassy of India, Berlin, and Deutsche Bank and Khaitan for supporting us in the MIM program today with this very enriching webinar. As we draw to the end of the session, we'd like to remind you that there are many more sessions coming up in the coming weeks. We will be updating you on the LinkedIn pages of MIM and also through emailers. I'd like to invite Mr. Manisha from the Embassy of India, Berlin, to finally give his remarks for the closing.
Hi, thank you, Jamli. Am I audible?
Yes, you are. Yeah.
Perfect. First of all, I would like to thank all our expert speakers from today, Mr. Manish Singh and Ms. Bhargavi Patel from Deutsche Bank and Ms. Manisha Shroff from Khaitan & Co. And also I would like to thank all our participants from today. One second, yeah. I hope I'm also visible right now.
Yes, you're visible very well now. Yeah, yeah, Manish.
So I would like to thank all the participants as well. We'll keep on bringing such interesting topics for the German investors time and again, and also in the future. And we expect that we will be able to answer your queries on all these topics through our expert speakers. If you have any further query to these topics, please feel free to write to us on our MIM hotline. We'll share our contact details and also the presentation from the speakers, and hope that we can bring more such topics to you. And also feel free to recommend any topics which you think that it's of interest for you and can help you better in your plans to enter into Indian market. With that, I would like to thank everyone and wish you all a nice day.
Thank you everyone for joining us. As Manish mentioned, the presentations will be shared with you and the recordings as well of the presentation. So thank you so much for joining in. Until we see you again, stay safe and stay healthy. Thank you.
Thank you.
Thank you.
Thank you.
Okay.